Welcome to AM Best Audio.
Welcome to this AM Best Outlook briefing. I'm John Weber. Over the next hour, we will be covering our outlooks for the main segments of the U.S. insurance industry for 2026. AM Best analytical staff will take us through the 2026 outlooks and the global economic, social, and technological trends that are shifting the industry and key factors expected to shape results in 2026. Now, if you have any questions for our panelists, please use the Q&A tool on your screen and we'll do our best to recognize them during our program today. Now, this session will provide outlooks for the property casualty personal line sector. That will be hosted by Richard Adanazio, Senior Director. Property casualty commercial lines by Carlos Wong Fupui, Senior Director. Delegated underwriting authority by Jacqueline Lentz, Senior Director. Life Annuity by Eric Miller, Senior Director. Health by Sally Rosen, Senior Director. And last but not least, Global Reinsurance by Michael Lagomarsino, Senior Director. Sorry about that, Mike. Now we're going to kick things off today with Rich Adanazio and PC Personal Lines. Rich, what do we have?
Yeah, thanks, John. So the outlook for the personal line segment remains at stable. The segment consists of two primary lines, personal auto and homeowners. Personal auto, which was revised to stable in 2024, represents over half of the segment's premium and therefore heavily influences results. For homeowners, the outlook was just recently revised to stable from negative. Supporting the outlooks is improved rate adequacy and continued refinement in terms of pricing segmentation and portfolio optimization across both lines. As a result, we're seeing material improvement in underwriting performance, particularly in personal auto, and while not as strong property. As carriers work toward producing consistently profitable results, they remain focused on protecting solid risk-adjusted capital positions, which has been an ongoing strength for the segment in aggregate. While the segment has relatively short-tailed lines of business, the improved interest rate environment has provided additional tailwinds from an operating performance perspective. Post-pandemic rate needs grew substantially given inflationary pressures on loss costs, including parts, materials, and labor, as well as medical and litigation expenses. While elevated loss costs remain a concern, rate change needs are more manageable as companies have closed the rate adequacy gap. Accordingly, we're seeing less double-digit rate change needs, particularly in personal auto, easing the burden from a regulatory approval perspective. The continued evolution in terms of price segmentation remains a key factor, with carriers developing refined granularity regarding risk factors and their overall level of exposure. These more refined underwriting practices not only better match rate to risk, but also have allowed companies to hone their risk appetites and cull portions of their book of business that fall outside of tolerance levels. These underwriting initiatives have benefited from ongoing system and technology implementations. Overall, companies are utilizing technology across all facets of the business, including distribution, underwriting, policy administration, as well as claims. And we expect these trends to continue, particularly as companies incorporate various AI offerings and, importantly, evaluate their expense structures. As noted, challenging weather patterns has driven carriers to revise their risk appetites. In some cases, those without scale, a unique niche, or some other competitive advantage have exited markets altogether. This is most prevalent in the homeowner space, as it is inherently more challenging from a rate perspective, given the timing and earning rate increases with 12-month policies compared to 6 months for most auto products, as well as the more disparate rating characteristics we see in property. Given its required dependence on reinsurance, the homeowners line is heavily influenced by reinsurance market conditions. Several years ago, the shift in the reinsurance market was profound, with reinsurers becoming more selective in their capital deployment, reflected in higher retentions and co-participations for cedents, as well as significantly higher pricing. As a result, primary insurers bore more of the loss during a challenging weather period and needed to significantly reevaluate their risk profiles, coverages, and overall level of exposure. Currently, modest softening in property cat rates has been observed and is expected in prospective renewals, particularly for loss-free programs and layers, as well as for those cedents with proven underwriting expertise advantages. The various actions by cedents to better mitigate losses has allowed them to reap some benefits from a reinsurance purchasing perspective, which is a credit positive, and an important consideration in the change in the homeowner segment to stable. Now on to the headwinds. While the outlook is stable, there are certainly challenges remaining. Although rate adequacy has improved considerably, overall loss costs remain elevated for both the auto and home lines. This is a function of not only inflation, but costs associated with new, more sophisticated vehicles, as well as more aggressive driver behavior leading to higher medical and litigation expense trends. While not seeing a meaningful impact thus far, the uncertainty surrounding tariffs and their impact on loss costs is a potential overhang for the segment. As always, weather remains an important consideration. While the 2025 hurricane season generated minimal losses in the U.S., carriers continue to be impacted by so-called secondary perils, such as severe convective storms and wildfires, with losses from the January California wildfire and the Midwest tornadoes in the spring and summer impacting full year 25 results. Given the increased impact of these perils, catastrophe mitigation and enterprise risk management programs need to account for both frequency and severity-driven volatility. Here again, we see companies reevaluating their risk appetites. In some cases, particularly for small and concentrated writers, the ability to effectively manage their risk profile has been a challenge, leading to declines in capital and ultimately their credit ratings. Given the challenging pricing environment of the last several years, consumer shopping behavior has become more active, particularly considering overall economic sentiment. The combination of maintaining policyholder retention levels, growth goals, and improved line of business margins may spur a more competitive landscape. As carriers post improved underwriting results, it is realistic to expect some rate softening. However, maintaining underwriting and pricing discipline are key factors in terms of the segment's stable outlook. To conclude, the stable outlook indicates our expectation that market trends will have a neutral impact on companies operating in the personal line space. Underlying our outlook is the expectation that companies will maintain that pricing discipline, even in an increasingly competitive market, particularly for personal auto. It's important to note that the stable outlook does not mean that all companies in the segment have a stable outlook. Carriers that have been slow to address market challenges or that do not have the means, expertise, or technological capabilities to keep pace have and will face rating pressure. Conversely, those that have been able to effectively stay ahead of these trends are more favorably positioned, particularly as increasingly competitive market conditions emerge.
That's an excellent presentation, Rich. We do have a couple of questions for you. First one being, where do you see the biggest opportunities for innovation in personal lines as carriers balance affordability pressures with the need for continued rate adequacy?
Yeah, I would say from an innovation perspective, it's an opportunity for companies to differentiate themselves. So whether that be through policy administration, the claims process, ease of doing business, making it easier for the customer, so that it's not just a price game, right? It's a differentiation in terms of service and the product offerings that that particular firm is offering.
One more question for you, Rich. How are shifts in homeowners and auto loss costs, particularly from weather severity and repair inflation, reshaping the strategies of leading personal lines carriers heading into next year?
Yeah, carriers continue to do that segmentation, that granularity in terms of rate, getting the right rate for the risk. You're going to see more of that continue, we would expect. And I think the frequency with which they're updating their approach throughout the year is also an important consideration.
Thanks, Rich. Next, we'll move along to Carlos Wong-Fupui, who will be presenting on PC commercial lines. Carlos?
Thank you, John. Yes, moving to U.S. commercial lines, AM Best is maintaining a stable outlook on the segment, and this is mainly because we believe that the segment has achieved price adequacy after several years of rate increases, probably reaching a peak between 2020 and 2021. Those rate increases have slowed down to a certain extent. In some pockets, we see even slight decline, but margins remain very strong. Touching on some similar topics that Rich mentioned earlier, so companies have been re-underwriting their books, being more selective on how they manage their risk portfolios, and this has been a reflection as well of pressures that they have been having from the reinsurance support. So what we see all in all is actually that despite some different trends that we see under the different subsegments which make up the U.S. commercial line segment, all in all, those overall profits, underwriting margins remain very healthy and sustainable in the near to medium term. Some of the most important subsegments that we see with strong, healthy margins are commercial property, for example, which has been much less affected by claim severity as personal lines. So we see very, very strong combined ratios, actually in the high 80s. Workers' compensation, despite pressures on rates and slight declines, again, the margins remain very healthy. And other lines such as medical, professional liability, title and mortgage, and in particular, the E&S subsegment, which we have recently changed the outlook from positive to stable, but still, we believe, maintains very healthy margins. On top of this, what we see as well is that capitalization, especially with the largest players, remains very sound. And say companies have been able to build on not just their underwriting profits, but also on the investment returns, and maintain significant buffers to manage the uncertainty that we see in the claims environment and the economic and geopolitical environment as well. So all in all, we have, say, the largest commercial writers producing combined ratios around the 90s and operating ratios 10 points below that. So significant component from investment returns, and this combined with a very conservative management of those investment portfolios with around 70% fixed income component. Reserves, the reserves environment, again, remains very stable. See, we have seen some pockets of pressure, especially on casualty lines, particular years, but going forward, I see this more mitigated due to rate increases, more strict underwriting, and some offsetting from releases on the property side as well. As we mentioned earlier, part of this is reflection of what is happening on the reinsurance market as well. So if at some point there was a significant dislocation on the reinsurance market on the property cat side, we haven't seen that pressure on the casualty side, despite significant concerns about social inflation and the litigation, the claims litigation environment. One of the benefits that we have as well in the commercial lines side is the way the E&S market has been behaving, which has worked as a safety valve to be more selective in terms of risks. So we have admitted carriers having more flexibility on the risks that they actually can retain or divert towards the E&S market, which keeps a very healthy flow of business. Now, this is not without ignoring the pressures that we have on a number of lines of business, especially on the liability side. General liability, commercial auto, D&O are three of the segments, significant ones, which are under a negative outlook at the moment. We see still pressures there, especially on the social inflation, claims litigation funding side, and this is putting pressure on underwriting and the reserving margins. Having said that, these are areas where companies remain very cautious. We have significant differentiation on the way those risk portfolios are being restructured, and as well, there is continued rate increases and benefit from investment returns on a long tail heavily reserved line of business. Climate trends, secondary perils remain a concern, but again, an area where companies have been becoming more selective and with the help of a much more cautious approach to the reinsurance support as well, so risks are being managed and producing profits in a very sustained way. So all in all, we believe that despite this difference between subsegments that we can have, say the whole commercial lines subsegment is likely to maintain these healthy profits for the near and medium term.
Very comprehensive presentation, Carlos. Can you take a couple of questions?
Of course.
Okay, first one, commercial lines profitability has diverged significantly by segment. Which sectors do you think are best positioned for sustainable improvement, and what factors will determine who pulls ahead?
At the moment, we feel very positive about how commercial property is behaving. Yes, so we think that companies have been very effective at the way of they are selecting those risks, and being able as well to use the E&S market when needed. So the strict underwriting is producing those very, very strong results. And despite concerns about regulation, about rate pressures on the workers' compensation side, we still believe that in most cases the margins are remaining very strong.
One more for you, Carlos. How are macroeconomic and geopolitical uncertainties influencing underwriting discipline and appetite across major commercial lines today?
I think that the main point there is about the uncertainty in making decisions and planning, and that in some way is benefiting current incumbents. So the stronger companies are in a better position to manage that uncertainty, and it's actually serving probably as a barrier to entry to those who would like to disrupt the market. So for existing players in the market is to a certain extent a benefit, and they are managing that uncertainty very well.
Thanks, Carlos.
Thank you.
Let's move along now and turn things over to Jackie Lentz, who will take us through the DUAE sector. Jackie?
Thank you, John. We've revised the outlook to stable from positive for the Global Delegated Underwriting Authority Enterprises, DUAE segment. This isn't a reversal of confidence in the segment. It's more aligned with the outlook and points we've seen on the commercial line segment, particularly the E&S subsegment. It's reflective of a shift in a period of rapid capacity-fueled expansion to a more moderated environment where selective deployment and tighter economics and heightened oversight are becoming more influential. The fundamentals remain strong, but the balance of tailwinds and headwinds may be shifting. The DUAE distribution channel continues to demonstrate sustained growth and resilience. It remains an important distribution channel for insurers over the business cycle. The U.S. market alone has posted 4 consecutive years of double-digit growth, and the number of DUAEs continue to rise. And while E&S growth has been a major driver, recent rate moderation, more selective capacity deployment suggests that growth going forward will be more measured. And while capacity remains strong and we see that programs are routinely being added, the market has become more selective and is not without challenges. As DUAEs have become more intertwined with E&S and fronting markets, reinsurance dependence has increased. The DUAEs may experience further capacity tightening, commission compression, and more narrow underwriting margins. Rapid growth in the DUAE startup segment has increased some execution risk as well. Market participants are demanding stronger internal controls, higher data quality, more robust enterprise risk management practices. Regulators may begin to raise concerns about delegated business quality and arrangements. Broker consolidation can concentrate placement control, which can pressure commission terms and increase acquisition costs for independent, perhaps smaller DUAEs, particularly those with some immature loss history or already thin margins. With DUAEs operating under somewhat lighter regulatory framework than insurers, discipline in underwriting, reserving, and governance at the DUAE become even more critical. Further, the segment remains very competitive. This comes despite many seeing the need to manage through some adverse development and consistent pressures in some of the longer tail casualty lines of business. And this could perhaps raise the bar on MGA casualty programs' ability to earn a profit commission over time. So despite these pressures, strategic partnerships between carriers and DUAEs remain very strong and a tailwind. We're seeing more long-term arrangements supported by profit commission, loss corridors, and even captive participation. These structures deepen alignment and demonstrate mutual commitment, but they also raise, again, the performance bar. Good underwriting performance remains a key differentiator among DUAEs. DUAEs continue to distinguish themselves through niche expertise and tailored solutions, particularly in specialty and hard-to-place risks. Their use of proprietary data, technology, and specialized underwriting knowledge allows them to build programs that traditionally carriers can't easily replicate efficiently or bring to market quickly. They're also increasingly active in non-traditional structures like fronting, hybrid fronting, collateralized reinsurance, and insurance-linked securities. This offset by some potentially tighter collateral requirements and counterparty risk concerns. This agility of the DUAE, though, gives carriers a cost-effective way to access niche markets without taking on full volatility, reinforcing the strategic value of that DUAE partnership. The segment's versatility is supported by new opportunities for MGAs, whether it be in the cat-exposed area or other new and emerging risks. The segment's flexibility supports an investment in talent and technology. Without legacy systems, DUAEs can leverage advanced analytics, digital platforms, and data-driven placement strategies to improve selection, streamline operations, and scale quickly. Their entrepreneurial culture attracts both underwriting specialists and tech-savvy talent, and their lower overhead allows them to offer competitive compensation. This combination of technology and talent continues to be a major differentiator. In the overall picture, the global DUAE segment remains an important and innovative part of the insurance value chain, but selective capacity, rising scrutiny and governance, and more discriminating expectations of the participants are tempering our view, and the stable outlook appropriately reflects the current risk-reward conditions in the segment.
Outstanding presentation, Jackie. We do have one question for you.
Sure.
What are we seeing in terms of DUAE specialization by either line of business or product?
NAIC filed statements show that more than half of reported MGA premiums are written through MGAs that focus on specific lines of business or specific risk classes. And with these MGAs, we've estimated that MGAs specializing in property represent around 11% of the premium, followed by private passenger auto, crop, general liability, and workers' comp. Since risks and exposures are always evolving, over the next 3 to 5 years, we might see new DUAE opportunities emerge for liability from renewable energy projects, offshore wind, energy storage, battery fire explosion risks, some EV battery risks, autonomous vehicle, autonomous transportation, AI, and robotic liability, and plenty of evolving cycle threats that might spur additional specialized cyber products.
Thanks, Jackie.
Thank you.
We're going to turn things over to Eric Miller now, who will take us through the life annuity sector. Eric?
Thanks, John. So we have 6 main points here, focusing on the tailwinds and headwinds for the industry. To start it off, our life and annuity outlook remains stable. Starting with the balance sheet as the linchpin, capital and surplus and risk-adjusted capital overall remain healthy. This is the linchpin of the ratings process and the linchpin for the outlook remaining stable. There has been a lot of growth recently, and we've seen with the reserve growth and the expenses that go out with new product launches, we've also seen surplus grow with that. And more importantly, we look at things like surplus to liability ratios. They've maintained, we're kind of where they were about 4 or 5 years ago. And risk-adjusted capital levels, being the linchpin, remain healthy for the industry. We look at peer groups and segments. They remain, the median BCARs remain kind of where they were 4 or 5 years ago. We're not seeing any material declines there. So as the linchpin of the ratings process, surplus capital and surplus liability ratios and BCARs remain healthy. Now, the life annuity industry is what anyone would call a mature industry in the United States particularly, but we see strong top-line growth we haven't seen in many decades. Post-COVID, we saw a spike in mortality-based products, individual life, but obviously with the rise in interest rates, we've seen dramatic increases in individual annuity lines. Over the last 4 years, total growth, direct premiums written is about 40% for the industry, but it's being driven largely by individual annuity, which is up almost 100% in the same 4 to 5 years. And even other group annuity products like PRT business has also seen significant growth. Even with the surplus growing and top line growing and being costly, the industry remains consistently profitable. This is probably the most surprising thing out of the bunch. Profitability remains key, and the 3 main focuses, whether it's fees, underwriting, and spreads, all remain consistently profitable. So we're looking at the spread-based. We've seen, assets and liabilities are particularly longer in duration than they are in the other outlooks we just discussed. And it's taken many years for the reinvestment portfolio to kind of kick in and move up the interest rates that we've seen with the changes in rates. Expect to see continued more investment income from these, and spreads remain consistently healthy. And when we look at mortality-based products, mortality took a hit obviously during COVID, and we've seen some effects of that, such as deaths of despair, opioid epidemics. All that is kind of in the past, and mortality has continued to improve. So underwriting is expected to improve and maintain in the near term as well. And finally, we look at fee-based products, whether that's assets under administration, separate accounts, or just total assets under management. This has been buoyed by dramatic market returns the last couple of years. And even though we've seen some outflows, particularly in the separate accounts and variable annuity business, market appreciation has far outweighed that, and we've seen strong growth in the fee-based businesses. So those are all kind of the positives, but obviously we have some headwinds. And I just discussed that surplus was up and the risk-adjusted capital was being maintained. But even while those are true, the quality of that capital has deteriorated. We look at an increase of offshoring and an increase of just moving to a more economic reserving practices instead of statutory reserving, moving to offshoring reserves, moving to more debt within the capital structure, moving to more captive reinsurers, where the risk isn't really being, risk is being retained, it's not really being removed, particularly from the rating unit. We're also seeing more debt within the capital structure, particularly things, funding of the captives, or even more surplus notes in the capital structure. And all of these just lead to a lower quality of capital, even though the risk-adjusted capital model may put out the same number, within the quality of capital, particularly for the industry overall, has deteriorated. And that same quality of capital is also being impacted in the quality of assets. And this is more widely being put out in a lot of other presses, and we are consistent with that method, that message being that the quality of assets deteriorated, whether that's increases in structured credit, increases in uses of private letter credit ratings, and or affiliated investments. All of those leads to lower quality of assets. Now, risk-adjusted capital models like our BCAR or RBC are looking at a default level charge right in the models. But when we think about things such as structure risk, complexity risk, or more importantly, the liquidity risk, we think all of those aspects have been rising and increasing risk within the investment universe, despite risk-adjusted capital being maintained. And finally, we look at the macroeconomic conditions. You've heard of some other outlooks talk about tariffs and the impacts of politics. But here, we're really focusing more on the interest rates. We've already seen interest rates start to decline. And just like we've seen interest rates be a large part of the story for dramatic increases in premiums, particularly from the individual annuity market, we would expect that if rates go down faster than expected, we can see that start to impact also some of the direct premium growth there. And more importantly, there have been a lot of new players coming into the market, and not just small players, but medium and larger sized players. And this could impact sales, and they could be fighting for a smaller growing pie. Now, the pie has grown significantly over the last couple of years, but even some detractions in that growth with all these new industry participants could make more competition in the industry and could lower spreads. So for all those reasons, we're maintaining a stable outlook for the industry.
Well, thank you for that very comprehensive presentation, Eric. We're going to move along now and turn things over to Sally Rosen, who will take us through the U.S. health sector. Sally?
Thank you, John. So AM Best is maintaining its negative outlook on the U.S. health insurance industry. AM Best revised its outlook to negative in August of 2025, and the pressures that appeared at that time remain in place today. The U.S. health insurance industry is experiencing a broad-based increase in medical expenditures and higher utilization across a number of medical services, as well as an increase in the coding intensity of medical services reflecting higher member acuity. All segments are experiencing an elevation in medical trends, although the degree varies by line of business. In looking at impacts by line of business, we're going to start with Medicare Advantage, which is experiencing elevated utilization and higher provider costs. The elevated utilization trend began in 2023 and has lasted longer than expected with no indications of abating. Some of this is attributable to individuals delaying care until they are eligible for Medicare to receive enhanced benefits and lower out-of-pocket costs. Other pressures facing Medicare Advantage plans include declining star ratings and the impact of the change to the risk adjustment model. The average star rating has declined annually since the 2023 calendar year. In 2023, over 2/3 of plans were rated 4 stars or higher, and by 2026, only 40% of plans were rated 4 stars or higher. Additionally, CMS has been phasing in a new risk adjustment model, which is used to determine Medicare capitation reimbursement. This new model, known as V28, has fewer claim codes and is expected to reduce the risk adjustment reimbursement. V28 has been phased in over a 3-year period, and for 2026, the reimbursement will be entirely based upon the new model. The individual ACA marketplace has been impacted by a large rise in utilization and medical costs, as well as a change in utilization patterns that negatively impacted earnings. In the 2025 open enrollment, health insurers added members that were disenrolled from Medicaid due to the end of the public health emergency. The utilization pattern of these members is more similar to a Medicaid member, with greater utilization of emergency room and behavioral health services. Commercial group market, also known as the employer group, has also been impacted by the rising medical cost trends. Health insurers have seen higher utilizations as well as rising medical and pharmacy costs. Furthermore, the employer group market has also been negatively impacted by the drastic increase in the usage of GLP-1s, although we would note that many employers and health insurers are now covering this class of drugs for uses other than weight loss. Medicaid managed care plans have experienced higher morbidity of enrollees, correlating to higher medical utilization and greater costs than was expected. This higher morbidity is in addition to the acuity mismatch that Medicaid plans are facing due to a notable decline in enrollment as a result of the redeterminations at the end of the public health emergency. Insurers have been working with states to correct the rates to reflect the experience. However, given the elevated medical trends and higher morbidity than anticipated, pricing in the Medicare segment is taking longer than expected to correct. Additionally, there's also elevated legislative and regulatory concerns. The lack of action by Washington on the expiration of the enhanced subsidies has caused additional pressure on the individual ACA market and will likely result in worsening underwriting results in the fourth quarter of 2025 as individuals seek care before losing coverage. And without further action, we expect an increase in the number of uninsureds in 2026. Medicare Advantage plans, as previously mentioned, are facing changes from CMS from lower star ratings and V28. Additionally, the One Big Beautiful Bill will place added pressure on Medicaid in late 2026 and into 2027. Work requirements are being implemented by the end of 2026. Most other provisions of the bill go into effect in 2027 and beyond. And according to the Congressional Budget Office, the combined impacts of the bill are projected to reduce federal and state Medicaid spending by over $900 billion over the next decade. In looking at the tailwinds for the industry, the U.S. health insurers maintain more than adequate levels of risk-adjusted capitalization, as favorable earnings over the past 5 years have been accretive to capital and kept pace with premium increases. While risk-adjusted capital is expected to decline, given the lower earnings, membership declines in 2026 may offset some of this pressure. Health insurers typically maintain conservative investment portfolios, which have provided solid net investment income and has partially offset underwriting pressures. Health insurers also maintain more than sufficient liquidity, driven by positive operating cash flows, high cash balances, and most have additional sources of liquidity if needed. As of today, the enhanced subsidies are expected to end at the end of 2025 without passage of a bill by Congress and President Trump. Renewal notices have been sent out to insureds assuming the enhanced subsidies are being discontinued. It is expected, as mentioned, that many individuals will drop coverage over cost. In addition to pricing for current trends, most health insurers included an adjustment in 2026 in their premium rates to account for anti-selection, as healthier individuals are more likely to drop coverage. Additionally, health insurers are implementing pricing actions and plan design changes across all product lines, which are reflective of the increased medical cost trends and utilization trends, as most insurers do not see these trends reversing in the near term. Health insurers will continue to evaluate their product offerings and geographies, and some carriers will exit certain markets as they focus on improving operating performance.
All right, thanks, Sally. Great presentation. We do have a couple of questions for you. First one, if insurers priced for adverse selection in the individual ACA market for 2026, what are AM Best's concerns about the expiration of subsidies?
Yeah, sure, John. So it's expected that, as I mentioned, many individuals will drop coverage. This is going to result in an increase in uninsureds, and that puts pressure on provider systems because these people can't pay, and it results in a rise in uncompensated care. So without any further legislative action, the provider systems are then going to have to go to the insurers to raise the contracted rates, which it sort of has a ripple down effect. Additionally, if Congress were to pass a bill with some form of extension of the enhanced subsidies, a special enrollment period would likely be needed, as the current open enrollment ends on January 15th. Health insurers would need to perform outreach to reach individual members and inform them of the revised rates, because rates will change to reflect any changes in the subsidies. There's also a concern of an additional anti-selection, as individuals who may have opted out of coverage but now need medical care may decide to enroll during a special enrollment period.
All right, one more for you, Sally. If AM Best thinks that operating performance for health insurers will improve in 2026, why is the outlook remaining negative?
Sure. So, we have some concern that the elevated trends may not abate and could continue to rise. And we continue to see elevated pharmacy trends, including specialty pharmacy, which are more injectables, and higher prices. It also can take several pricing cycles or rate cycles to get the rates to address all the issues the industry is facing, because most contracts renew once a year. And as I had mentioned, there is some concern about the increase in the uninsureds and what that could do to contracted rates from provider systems.
Thanks, Sally.
Thank you, John.
We're going to turn things over to Michael Lago Marcino at this time for our last presentation of the day on global reinsurance. Michael, take it away.
Great, thanks, John. Although we have a positive outlook on the global reinsurance segment, unlike the other segments discussed, we did not update our outlook on the segment prior to this webinar. The reason we didn't is that unlike the primary segments, the January 1 renewal season is a key barometer for the underlying trends that will drive credit fundamentals for global reinsurers over the next 12 months. There are several key metrics that we will be paying particularly close attention to at the upcoming renewal period that will influence our view on this segment's outlook. We will look to update our outlook on the global reinsurance segment in early 2026. However, to help level set our discussion this afternoon, I'd like to briefly recap the reasons supporting our change to a positive outlook on the global reinsurance segment in June of 2024. It wasn't just repricing, but reinsurers de-risking balance sheets through tighter terms and conditions and higher attachment points. Reinsurers returned to their core role of capital protection. Rising losses from secondary perils, sustained investor pressure, and a lack of material startups reinforced underwriting discipline. Together, these factors supported expectations of strong and durable earnings, which is what we have observed to date, and support our positive outlook, and supported further by the following tailwinds. Although competitive conditions are increasing in property cat, pricing overall remains well above pre-2023 levels. Renewal pricing varies by ceding experience, layer, and geography. In addition to terms and conditions and attachment points remaining unchanged, reinsurers have resisted offering broad aggregate covers. That discipline has kept margins attractive. We expect reinsurers will remain discerning in risk selection, pricing, and structure entering 2026 renewals, despite increased competitive pressures. Despite another year of insured natural cat losses exceeding $100 billion, this segment is set to record another year of strong underwriting and operating results in 2025 and remaining well above pre-2023 levels. That resilience reflects the corrective actions taken in recent years and that I commented on. This segment remains well capitalized with dedicated reinsurance capital projected to grow by 7% in 2025, reaching a new record level. Growth has been driven by retained earnings and continued growth in catastrophe bonds. Demand for reinsurance remains strong, driven by heightened cat activity, changes in models, and macroeconomic uncertainty. This has led cedents to purchase greater amounts of protection and higher limits. We believe reinsurers will balance the deployment of capacity in line with demand while ensuring profit targets are met entering 2026 renewals. Life health reinsurance continues to provide earnings diversification, despite pockets of adverse experience. And even though several central banks around the world have been cutting interest rates, they remain well above pre-2022 levels, supporting operating profitability over the near term. Of course, the operating environment isn't less risky or uncertain, as evidenced by several headwinds. Similar to what you heard on the primary side, social inflation, third-party litigation funding, and nuclear verdicts have all increased loss cost severity on U.S. casualty lines. Despite significant primary company rate actions, underwriting adjustments, and enhanced claims functions, questions over rate and reserve adequacy persist. Reinsurers have responded by cutting back on capacity, lower ceding commissions, and significantly increasing rates on excess of loss placements where and when appropriate. Reserve strengthening actions have also been taken, though these have been offset by favorable development elsewhere for most reinsurers. Nevertheless, a significant amount of uncertainty remains. As noted, the frequency and severity of natural catastrophe losses continue to increase. While reinsurers remain better positioned than before given their elevated attachment points, losses remain frequent and costly. Geopolitical tensions, trade disputes, and ongoing economic uncertainty create increased uncertainty over claims cost, supply chains, and financial markets. Finally, growing competitive pressure on property cat reinsurance entering 1/1/26 renewals places greater pressure on the segment's top and bottom lines. And although our expectations over the next 12 months are a bit more muted than a year ago, reinsurers are in a strong position to navigate this transitioning market as margins remain healthy, capital is strong, and diversification remains a strength. So what might change our outlook? So this slide highlights some of the key factors that could influence a change in our outlook to stable on this segment. These include broad and significant rate reductions, going away from that discipline that I was talking about, if we saw a significant loosening in terms and conditions, or if reinsurers started lowering their attachment points, entering into more working layers or providing more broad aggregate covers. We're also going to track the margin between prospective ROE and the cost of capital or equity. And as those two come together, that could be another indicator of a change in our outlook. Now, not all of these broad areas need to happen at the same time. It could be one significant change in one of them that could change our outlook to stable. And as I mentioned earlier, we'll be incorporating the results of the 1/1/2026 reinsurance renewals into an updated outlook on the global reinsurance segment in early 2026.
Thanks, Michael. We have one question for you. With competitive pressures picking up in property catastrophe, does AM Best expect to see an increase in M&A activity over the next 12 months or so?
I would say no to significant M&A, and I think part of that is driven by just the amount of consolidation that this segment has gone through over the last 10 or 15 years. With the biggest and most sophisticated reinsurers just gaining scale and importance, as there has been a flight to quality over time. And also, there's still opportunities to deploy capital into the market and able to get attractive returns, even though that might be shrinking a bit because of the competitive pressures I talked about. Acquirers need to also be cautious when they're buying a multi-line company because of those uncertainties around casualty reserves from social inflation. And we would just expect a greater amount of capital management initiatives, greater buybacks or special dividends perhaps, right, if there's no opportunities in the market. On the other hand, we are definitely not seeing any interest from any startups entering the segment. And that's something that we've observed and commented on over the last couple of years. There's definitely not a lack of capacity in the market, and there is a need to execute on a long-term strategy, which is hard to prove to investors, especially with the market changing somewhat.
All right, thank you, Michael. And thank you, panelists, one and all, for outstanding presentations here today. We'd like to let our viewers know that we will have a complete replay of this briefing posted within the next day or so. We'll have a full transcript out within the next week or so. For AM Best, I'm John Weber.
Looking to get the full attention of the insurance industry? We have the platforms that will do just that. Whether it be AM Best TV, AM Best Audio, Best Review Magazine, or Best Day. Find out more by calling AM Best Advertising Sales at 908-439-2200, extension 5399, and have a great day.